Two people, same company. Same starting salary, same job title. Person A, disciplined, focused, saved aggressively from day one, lived below their means, built a cash savings account that grew year after year. By year 10, they had $200,000 in savings. By year 20, $500,000. By year 30, over $1 million in cash and cash equivalents. They felt secure. They were secure, no market risk, no volatility, just steady, predictable growth of their savings. Person B, also disciplined, but different priority. Started investing immediately, even when it felt uncomfortable. Put money into index funds and retirement accounts from the first paycheck. Didn't wait to be ready. Didn't wait for the market to look right. Just invested systematically every month. By year 10, they had significantly less cash than person A, maybe $100,000. By year 20, maybe $200,000 in readily accessible savings. But their invested assets, the ones that were supposedly riskier, supposedly less stable, had been compounding, growing, working. 30 years later, person A and person B sit down and compare their financial positions. The numbers tell a story that surprises almost everyone who hasn't seen it before. Not because one person was smarter, because one person understood something about time, compounding, and what actually builds wealth that the other person mistook for caution. Today, we're going to walk through what actually happened to each of them. Not theory, actual math, actual outcomes. The specific way that person B's risky strategy produced dramatically more wealth than person A's safe strategy. Person A, the saver. Let's follow person A's journey carefully. Year 1, saves $12,000. Total accumulated, $12,000. Year 2, saves $12,000, gets a small raise. Saves $13,000 total, accumulated, $25,000. Year 3, saves $13,000, accumulated, $38,000. This continues consistently. Every year, savings accumulate. No losses, no volatility. The number only goes up. Person A feels secure watching it grow. By year 5, $80,000 saved. By year 10, approximately $180,000 saved. By year 15, approximately $330,000. By year 20, approximately $520,000. By year 25, approximately $760,000. By year 30, approximately $1,050,000 in total savings. The math is straightforward. Disciplined annual savings compounded over time, $1 million. A genuinely impressive achievement built through consistent discipline and restraint. Person A feels wealthy. They spent 30 years being responsible. They have $1 million in liquid, safe assets, no risk. No drama, security. Person B, the investor. Now let's follow person B's same starting salary, same annual raises. But instead of keeping money in savings, they invested in index funds. Year 1, invest $12,000 into a broad market index fund at an average cost basis. Total invested, $12,000. Account value, $12,000, ignoring the time value and assuming they just invested. Year 2, markets perform. The $12,000 grows to approximately $13,000. They invest another $13,000. Total invested assets, $26,000. Current value, approximately $28,000. Year 3, markets have volatility. Sometimes up, sometimes down. They keep investing. Their invested assets are now approximately $40,000. This is where person B's strategy diverges from person A's in ways that only become visible over decades. Person B is experiencing volatility. Some years the market is up. Some years it's down. The account value fluctuates. Emotionally, this is harder than watching a steady savings balance grow. But something is happening underneath the volatility. Every dollar that person B invested is getting exposed to market returns. The historical inflation-adjusted return of a broad stock market index is approximately 6 to 7% annually over long periods. By year 5, Person B has accumulated approximately $6,000 to $5,000 in invested assets. The account value is approximately $80,000. The additional $20,000 is gains money that was created by investment returns, not by Person B's direct savings. By year 10, Person B has invested approximately $180,000 total, but the account value is approximately $330,000. The market has created approximately $150,000 of additional value through compounding returns. Person A at year 10, $180,000 in savings, all from direct contributions. Person B at year 10, $330,000 in invested assets, with $150,000 coming from investment returns Person A never had access to. Person B has $150,000 more at year 10, and the gap is about to accelerate. By year 20, Person B has invested approximately $520,000 total, but the account value is approximately $1.3 million. Investment returns have created approximately $780,000 of additional value. Person A at year 20, $520,000 in savings, all from direct contributions. Person B at year 20, $1.3 million in invested assets, including $780,000 in gains. By year 30, Person B has invested approximately $1,050,000 total. The account value is approximately $3.2 million. Investment returns have created approximately $2.1 million of additional wealth. Person A at year 30, $1,050,000 in savings. Person B at year 30, $3.2 million in invested assets. Person B has 3 times the wealth. With the same starting salary, same annual contributions, same job, same discipline. The only difference, Person B invested while Person A saved. Why the math diverges so dramatically? This gap doesn't happen by accident. It's the mathematical consequence of how compounding actually works. Compounding has 2 phases. In the early years, compounding is weak. You're adding more to the account through your contributions than the market is adding through returns. Year 5, Person B has invested $6,000 to $5,000 in gains are only $15,000. The contributions are doing more work than the returns are. But as time goes on, this shifts. By year 15, Person B has invested approximately $415,000, but gains are approximately $225,000. Returns are now producing almost as much value as contributions are. By year 20, contributions and returns are approximately equal. By year 25, returns are producing more value than contributions. The market growth is larger than the annual savings. By year 30, the market growth is more than double the annual savings. The compounding has fully taken over. The money is making more money than Person B is making through salary. This is the power of compounding over long time horizons. It's not linear. It's exponential. The curve gets steeper with time. Person A never experienced this. They were earning 0% on their savings while Person B was earning 6 to 7%. Over 30 years, that difference compounds into something that looks impossible until you trace through the math. The volatility question that nobody asks. Here's the argument that Person A would make. But what if the market had crashed? What if Person B had invested everything and then the market fell 50%? They would have lost everything. This is the legitimate concern about investing. Volatility is real, drawdowns happen. But here's the part that the argument misses. Person B didn't invest everything at once. They invested systematically over 30 years. They invested in 2008 and 2009, the worst market years in decades. The market fell 50% from peak. Person B was buying at the bottom, not all at once, but systematically as part of their normal routine. By the time the market recovered, Person B had accumulated even more shares at depressed prices. The recovery created enormous gains on those depressed price purchases. They also didn't need the money during the downturn. They were still working, still earning salary, still able to invest. The downturn was an opportunity, not a crisis. Person A, with $1 million in liquid savings, felt secure during the downturn. Person B, with a portfolio that temporarily fell in value, had the discipline and cash flow to see it as a buying opportunity. Over 30 years, there are multiple significant market downturns. Each one is a moment where Person B is investing at lower prices. Each recovery is a moment where that discipline is rewarded. The volatility that looks scary from the perspective of 1 year looks like an opportunity from the perspective of 30 years. What changes in the second 30 years? Here's where the story gets really interesting. Person A, $1 million in savings. They stop working or transition to part-time. They can live off their accumulated savings or invest them now, decades late, as they approach retirement. The $1 million in savings, if invested at this point for another 30 years at 6% returns, would grow to approximately $5.7 million. But they've lost 3 decades of compounding. If they had invested from day one, that $1 million in investments would have grown to approximately $5.7 million. Instead, they have $1 million in savings plus maybe $1 million in investment returns on the $1 million. Approximately $2 million total after 30 more years. Person B, $3.2 million in invested assets. If they stop working, that $3.2 million can generate substantial income for the rest of their life. If they keep working even part-time, those assets continue to compound. In 30 more years of compounding at 6%, $3.2 million becomes approximately $18.3 million. The gap that existed after year 30 has not just persisted, it's accelerated. The compounding that favored Person B continues to favor them even more dramatically in the second 30 years. Person A made a logical decision: save money safely. It was not wrong, but it produced a fraction of the wealth that Person B's logical decision produced. The behavioral element Person A missed. Person A felt safe saving money. The number always went up. No stress, no volatility. No need to understand investing. But that comfort created passivity. They learned how to save, not how to grow wealth. Person B had a harder path emotionally. Markets crashed, investments dropped. Staying invested during downturns was uncomfortable. But that discomfort built discipline, patience, and long-term thinking. Person A mastered saving. Person B mastered compounding. And over time, compounding scaled far bigger than saving alone. 30 years, same income, same discipline, same sacrifices. One person ends with $1 million saved. The other ends with over $3 million invested. The difference wasn't intelligence or luck. It was one decision. Investing early instead of only accumulating cash. Person A chose certainty. Person B chose compounding. And over decades, compounding changed everything. Because in investing, the most valuable asset isn't money, it's time.